the DNA of trading. It's a money management system. Now, basically, what money management systems do is they go through and they allow you to loss prevention and how to overcome loss. And this is really important when you sit down to trade. If you don't have a loss recovery system or a loss prevention system or a sizing system that understands loss, you're never going to be able to trade successfully. It just won't work, at least not in directional trading. There are some ways to do it in non-directional trading, but non-directional trading doesn't make you much money. So your main learning objective is going to be loss recovery plan and loss prevention plan. This plan will center around trade sizing. So we got trade sizing. We're going to be using a money management profile and money management behaviors to accomplish this task. Okay, so we've laid out some mind maps around this. A mind map is essentially a tool that allows you to flowchart concepts as you learn them. All right. Now, the mind map that we're going to be using, we're going to start, the very first topic we're going to start with is loss prevention. Might as well fix it before we get into it. We don't want to have to fix it while it's occurring, so we want to get into loss prevention first. All right. Hold on while I get a drink of water. I'm going to put you on pause for a second. Okay. So your loss prevention, mastering the flow of information. We have models, alarms, historical volatility symbols, surprise news, and there might be some spelling errors in there, ratio, time of day, targets, and trend. And we'll be dealing with all these. Let's go to the next slide. Okay, to understand this, first we have to analyze our model. What type of model am I trading? A grid system, a stop and reverse system, a variance system, a scalping model, a long-term trend following system, or a mean reverting system? You have to know really what's the model do before you ever get into it. There's some terms that are going to come up in here that are vocabulary terms that you're going to have to know. They're at the very end of this document. You'll get a copy of them. I'll try to explain them as we go along. One is going to be a maze event, maximum adverse excursion and maximum favorable excursion. This is the farthest that it goes away from you, and this will be really important. So what is the trading edge of my model? Well, what is it? What time should it be traded? What is the maze event and the MFE event? Well, that's maximum adverse excursion, maximum favorable excursion, or highest open position profit and highest open position drawdown. That's not quite the same. What these are based off of closed positions. Like, how far does this system normally draw down? And there's some information that you need to glean or to understand. What's the main flaw in this model? How do you plan on avoiding May events? We call them May days and black swans and model failures. So the first thing in loss prevention is you have to go in there and start to understand this. Now, you can get these off a term called an equity curve. An equity curve is something that you, as an investor, create, or it's done in back testing, or someone gives it to you. Okay, well, what are they? They're really just your profit and loss as you go through a system and look at it. Okay, every system has an equity curve, every single one of them. And as you start to go through these equity curves, you need to look at them and see, what's occurring. So I can give you some examples of this. This is the equity curve that I'm going to bring up here. I'm just closing some stuff off so it'll look better when I bring it on the screen, so I can maximize it and make you see it a little bit better. This is an equity curve. I took a quick snapshot out of MetaTrader. I can show you how to generate these. And what this is an equity curve. If you notice these drawdowns right here, these drawdowns, normal drawdown, normal drawdown, normal drawdown, normal drawdown. So we could say that this little box represents a normal drawdown. This box represents a maze event, maximum adverse excursion. That's a maze event. That's bad. That's a bad thing. We don't want to occur. We don't want this to happen. Our whole job, one of our jobs in trading, is to avoid this. Now, you can get things called broker stops, or they design stops in where it just stops you from trading one day. It says, you know what, you drew down too much, and I'm just going to stop you out. You can't trade anymore. So on a model, you need to know what is its normal drawdown before it goes up. Well, that's a slightly different thing than what's in here for loss prevention, because loss prevention doesn't quite deal with that. You just need to know some information about your system, because if your system's behaving normally or abnormally, that's going to be one of our goals in our model. Is it behaving normally or abnormally? To understand this, there's a lot of vocabulary words that come up. We're going to deal with this system and really how to hone into it when we get to the section on ratios. But I needed to just introduce you to what is a maze event and what is an MFE event, and how do we tell that our model's failing. We don't want to be beat up right when and take one of those big drawdowns. That's the purpose of what we're covering right now. Okay. Now, as we go into this next little section here, hold on one second. It's just changing screen slow. I'm going to pause it because we're recording it until it flips through the screen. Just a second. Okay, it's switched back. Another way to do loss prevention is alarms. This is how I personally deal with it. I have to identify what can go wrong. I can have failure of an internet. I can have failure of an order, failure of a PC, failure of a dealing desk, failure of an add-on, or failure of a model. Now, I didn't list failure of the model there. I listed just models up above. But these are things that could go wrong. How do I know that? So be churning in the back of your head, how can I know that the INET's down? How can I know that my order failed? Well, there's alarms that come into this. When we're done, we'll have a workflow document. And a workflow document basically works like this. You're in a pickle. Something's gone wrong. How am I going to behave? That's something we're going to work on. Okay? Now, how can I fix the failures within a system or model? Well, step one, you must know that it failed. What are the fail points? What can it be in there? This is an alarm. Step two is map out a plan to fix these. This is called a workflow document and should encompass how I behave with that error. So you have to have workflow documents laid out. Now, I have a plethora of these inside my own mind map, and I lay out exactly what can happen. Now, the ways that I do this, I use a thing called well, I'll show you in just 30 seconds here. I'll bring up a way that I can identify failures. So one of the goals I want you to write down on your little 3x5 card or however you take notes. Oh, it's possible that there's a failure. What are the failures within the model? What are the failures within my trading environment? How can I be alerted to these failures? How can I start to work on them? Okay, that's going to be important. Okay. So the next thing that can cause failures is most models fail when volatility changes. Okay. So what is volatility? Volatility is really price over time, because we're only dealing with two scales on the chart, the price movement and the time movement. So we must model volatility with several thoughts in mind. Is it moving enough to cover costs? Okay. Is it moving beyond our stops and or targets? Okay. Do we think it will increase or decrease in volatility? These are all things that we have to address within our own trading. We have to know this. Do we think those things will happen? Okay. So one of the ways that we do this, we have to have what's called a volatility assessment. Okay. And a volatility assessment, there's a plethora of ways to do these, okay? So we have tools that calculate these out. I'm going to bring up my MetaTrader. I'm going to close some stuff, and I'm going to come down here where it says scripts. Now, I have a plethora of these. I'm going to start with a basic one. One is called FATTools, and it comes down here, and it says HV, just like we're talking about. It says Bollinger Band boxes. Now, when I pull this on, what this does is it goes back in time at this exact time of the day and then looks forward in time and says how far it moves. Okay, so I'm going to bring this box over here. This was 24 hours ago, and this is approximately how far it moves. Now, what I did, this is really what's called a standard deviation. I said, well, how far does it normally rise and how far does it normally drop? Well, this represents 80% rise and drop. So here's the middle, and here's your outliers. If it ran straight up, this would be an outlier box, outlier box, outlier box, outlier box. An outlier just means it ran farther than normal. It took you longer to hit your brakes. Like right now, it's snowing in Salt Lake. And so I try to tell my kid, listen, give more room because you're going to catch an outlier now. It's going to slide more. This is where normal is, but give yourself some room. So give yourself some room on this and let it go. Hopefully that's clear to you guys. That's called a volatility assessment. Now, most indicators, the volatility assessment is wrong. Why would I say that most indicators are wrong? Well, they don't go back. They don't go back in time completely correctly. They don't. What they really do is they go backwards 20 bars in time. Well, that's not how the market works, really. You should think of volatility more in terms of what's called time slicing. You should think of it more in terms of, hey, it's 7 o'clock in the morning. Do I think about the traffic flow on the way to work from 6 to 7 or from 7 to 8? Well, of course, I don't look at it from 6 to 7. I look at it from 7 to 8. So volatility changes or expectations that you have in volatility can ruin your model. So do we think it will increase or decrease is based on indicators that we use. So here's some indicators. We just did one that's called a Bollinger Band box that goes through and grabs it. Now we have more sophisticated indicators, less sophisticated indicators. Some of these indicators need lots and lots of data, okay? And there's different ways to be set up. Like the one that says a D zone right there, it's probably one of the best ways to get a volatility assessment, but it's a little bit hard on your computer, and it's a little bit tough for you to, you have to manage off your own data in MetaTrader, but it gives you some interesting things. Before we trade, we would like to know some good information. We would like to know, for example, how far does it move? How far does it go? How long does it take? Now, to figure out that information, we need some tools to do this, okay? One of the tools that I use, like I said, is called a D-zone. A D-zone is what's the term I want? It's a dispersion zone. And hopefully you guys are familiar with the term dispersion zone. A dispersion zone is a shotgun blast. When you shoot a shotgun, most of the data points will land right, hopefully square on the target you're hitting, and then you'll have the stuff that goes sideways outside that. That is going to be where we think it's going to go is in a dispersion zone always. And this is what makes trading hard. Really what makes trading difficult for you is you don't know exactly where it's going to go. That's a bugger. I mean, I would love to be able to tell you it's going to go right here, turn. You'll become infinitely wealthy and wise, and you won't spend all your money. You'll just become wise. That's not going to happen. Okay, what needs to happen is an understanding of money, and that's what really needs to happen. Okay. So I'm going to bring up this D-zone and show you what they look like. Now, there's a couple ways that we can analyze this. And what I'm doing on the other screen, just so you know, is I'm pulling up a euro. I'm dropping it on a chart. And I grabbed a bunch of data. Let me show you what I did. Okay. I went up here. I went to Tools, Global Variables. Or not Global Variables, Tools, History Center. Tools right here. I went to Tools, History Center, and I downloaded a bunch of data. I downloaded that much data. Okay. I downloaded that much data. Now to get that to work, you have to go to Tools, Options, and you have to tell it how much data you want to look at. And then you download that data. Now there's a script here. The data from MetaTrader is not the very best. I have some data that I purchased for calculating this. But what I'm going to do, this says HV assessment, and I'm looking for this where it says D zone. And I'm going to change this right now just so I can explain it to you. I'm going to change it to some green writing. Let's see, did we get that? Nope, it didn't stick. Let's grab the green writing right here, yellow. Okay, let's grab it on white then, because we're on a background. All right, if it's going to be stubborn, we'll type it in. You can type in the color that you want to work right there, as long as it's a capital W-I-T-E. Now, you can come down here, and what I'm going to do is I'm going to draw where support and resistance forms. Now, there's a whole big video about this. We don't want to spend a whole bunch of time on it. What this is going to do is it's going to run through, and it takes a minute. See where that says remove script? It takes it a minute to grab that information. Now, there's one other way that we can get our volatility assessment while it's doing that. I'm going to bring up another chart. We'll go back to this one. There's another thing that says, well, what time can I trade? I can go through all these things under HVs are different ways to figure that out. Then you have an indicator too that's called your price cycle and time cycle. And we can grab this stuff and say, oh, how far do I think it will move? Well, that becomes important for some of the analysis we need. So before you can ever start and you can understand a model failure, you have to understand how far is it going to move. Well, one of the things I can do, I can take on here, what time can I trade? Okay. Now, I could trade from 12 o'clock to maybe 1600. This is in Greenwich Mean Time. Those are the hours I can trade. Well, how far does it move during those hours? Between the blue and yellow line or green line? Colorblind. Maybe it's yellow line. But between these two, how far does it move? All right. That's something that we have to know. We really need to understand how far it moves. Well, this thing up here says that I'm going to try to zoom in on it so you can see it. I don't know if I can really quick. Those little blue dots are where support formed, and the red dots up here are where resistance forms. Now, hopefully everybody can see those. And this says there's a 74% chance of a drop based on that many data points. So it tells us how far does it move, which is the length of this one. This is the average drop right here. This would be how far we think it moves. This is also because the red line tells us which way it thinks it's going to go first. So this is how far, how long, and which way first, all contained on that. That it's going to take 10 bars on average and 9 pip drop. Okay? 10 bars on average and a 9 pip drop. Well, this becomes important in figuring out how far it moves. Well, what that did is it went back in time and it checked this Sunday night and said on Sunday nights, how far does it move? And it just started looking. It just started looking because we need to figure out how far it moves. Because what if it moves farther than that? Well, I need to know because maybe I planned on it moving so far. Now, there's going to be a nice little term come up that we'll explain coming up. Now, what we have right here is a second way we can prevent failure. Symbols. There are 3 types of symbols. They're called working crosses. This is in your vocabulary. So that's things that share a common border like the United States and Canada. They don't move very much. Normal crosses, they just move normal. They're just like the 3 little bears. This moves a little bit. This moves medium. And exotic crosses they share an ocean like the British pound, New Zealand. Some systems work on low volatility and correlations between pairs. Cost and spread are also a factor in picking the right symbol. So if you've picked the wrong symbol for the pair, it'll cause your model to stop. This becomes really important. Now, there's a website in there. For some reason it didn't pop up, but I'll bring it up. It's called Forex Ticket. Okay, it's called Forex Ticket. Now, Forex Ticket, it's a pretty cool little website. What it does, www.forexticket, forex.com. What this does is this shows you how far it moves. Now, it's really, really, really important to grab how far it moves, right? And when this changes, because if it moves farther than you thought, you can be in trouble. And so we really have to get a good grasp on how far it moves. Now, how far it moves is part of trade sizing. And that's your volatility assessment is used in where you place your stop. This becomes important. If you screw this part of it up, you'll land within a term called Brownian motion, which I will show you in 2 seconds. And you'll be in a lot of trouble. All right, so we're going to bring this up. This is going to be Forex ticket. Let's see, not YouTube. We didn't want YouTube. I wonder what that grabbed. I must have bumped something when I brought it over here. Let's grab this. Okay. Let's go to www.forexticket.com and I'm just going to volatility. This will pop up right here. Okay. Now, as I pop this up, this is where symbols become really important. This is the trend of volatility. It's been dropping, except for on that one, it's pulled back. Look at the trend in volatility. That's really a bummer. This makes it really hard to trade. That's the rupee. But this makes it really, really tough to trade. So watch this right here. This is 5 o'clock in the morning London time. And then this is 12 o'clock. This is the euro. This is called the upslope in volatility. This is called this right here. It's showing that Monday, Tuesday, Wednesday, Thursday is the biggest day for the euro to move. But overall, the trend in volatility has been going down. Well, some systems need the trend in volatility going up. This is just how far it moves in time. So we have to check this site. There's other ways to do it, but we check this site to determine things. Now, it's got other things in here that I use. I go to Tools and Charts, and I go in here where it says Forex correlation. Some systems need pairs to be highly correlated. And so one of the first steps in loss prevention is understanding this. Like, let's say you're trading the Euro USD and the Euro Swiss franc. Well, they're not correlated at all on a daily correlation. But if you're trading the Euro JPY and the GBP USD, they're highly correlated. That becomes important, okay, these correlations. So right there was the website Forex Ticket. But some pairs fell in certain kinds of volatility. This goes back to what we started with. What's my system need? And there's going to be some workflow that I'll lay out for you that you need to grab. So I'm going to give you an idea of how some of that works. This document I'm bringing up is called a mind map. Okay. And Neil, a buddy of mine, actually introduced me to this. And it's been exceedingly helpful in teaching people stuff. Okay. And what this does, this is Forex workflow. Well, I have personal workflow set up my MetaTrader, trade flow, education flow, workflow for problems. I need to know if there's a problem. I start laying out alarms. What do? I have to know this stuff. This workflow, this is something I haven't done. I haven't finished it. It's I'm writing these documents for different people. It's how to pick a power team. Well, power teams really, what could go wrong? Because you got to know who's on your team and who's not. Well, you got your dealing desk, so you would go to IBFX, and you'd say, "Hey, IBFX, I got a problem. I need contact info because I need to acquire contact info. This is a task, contact information." I use an introducing broker. It's called Zainers. I've been there for years and years and years and years. My broker's Lee. And you need the contact information over there. It doesn't cost me anymore to use them. Add-in software would be like FATTools. Well, what if you got a problem with them? What's your contact? A VPS, that just prevents loss. What's my contacts with them? Contact info. These are all people I deal with. And then MetaTrader, they don't help me at all. My dealing desk has to do it. But you have to pick some of these. Low commissions and low spreads are not the best way to pick a dealing desk. They're not. So you pick out power teams on here. Now there's a little thing that says marker index. This is in my map. Before I hit it, I'm going to go up one level. There's a reason I'm doing this, because whenever you use the marker index, right here, it builds it to wherever you are on the map. So marker indexes, and this will pop over here. This will start to build it. It'll go through and grab these. It'll just take it a second to go through and snag them. So it'll unbuild them and build them, and then you'll have like vocabulary words. See, that was just on the lower level that I was on where it grabbed it. These are techniques, and it really has to be rebuilt every time you go up and down. It's kind of a drag. So I usually turn them off when I go up one level, and then I wait, and then I'll turn them back on. So it's it's not finding them, and then it'll go through and find them again. Because what does that do? It tells me every workflow place in my document. There'll be a whole section for workflows. I'll show you. That's just a quirky thing in that software package, but you can use whatever software package you want. Okay, this is loss prevention. All right. So loss prevention, and that looks like it slid down. If you have surprises, if in one bar you cover half the volatility assessment, which you guys don't really know what a volatility assessment, you kind of do off this. But this is a volatility assessment right in here. This is called a D-zone volatility assessment. So what I'm going to do is I'm going to take off that line right there. I'm going to take off this line. This is the direction it's going to go. And I'm going to divide this thing into quarters. Okay, this is right here into quarters. I have indicators that do it. But this just drives it into quarters. And we can say, well, right in here, as it rises, it'll rise here a lot of times. Right here, not so much, not so much. Right here, maybe not so much. And by dividing this into quarters, this becomes a term called a behavior map. Now, a behavior map is as you start to trade, you say, well, what am I going to do if it goes right here? What am I going to do if it goes right here, goes right here, goes right here? And you have to make a decision what you're going to do beforehand. So when we go in here, if we have a surprise and you cover half the volatility assessment in one bar and it goes against you, so what does that mean? That's a big term. That's a big term for you guys. So all of a sudden you're sitting here minding your own business. Let's say you're short. Just theoretically you're short. I'm just going to grab a rectangle. And all of a sudden in one bar it explodes up to there and along. You better close your trade. That's called a behavior map, because you say if it explodes through the top of the map in one bar, well, why am I still in it? So it's something that you draw out prior to trading and you map it out. So this is a behavior map. It's where resistance forms and it's where support forms, and that's called a dispersion zone. You got to map out your behaviors before you even start, like what could cause a problem. That's what we're talking about. Okay, so we have loss preventions, ratios, and expectancy. Now, expectancy is out of Jan Tharp's book. It deals with probability of win, average win, probability of loss, average loss. If these variables change in a profitable system, you need to change them using your behavior map, which we just defined on the previous page. So what this does is if we come up here, this is an MT4I account. This is percentage of losers or winners, 62%, 35% losers. Average win is 118, but average loss is 138. Well, they're pretty close. They're almost 1-to-1. This becomes important because if these become out of balance, you want to know. Now, I get these out of really MT4I, but there's a plethora of places you can get them. If your probability of win is greater than your probability of loss, and it was in our system, it was 62% and 33%. Matter of fact, let's leave it on the screen at the same time so you can see these. And these come in real time. If your probability of loss and total loss, so if your probability of win is greater than probability of loss and total wins is greater than total loss. So total win amount, that's kind of worded bad. What that means is here is where instead of winning percent, it comes down here and it goes gross gets net. Gross minus gross gets net. And that's what this means. Gross wins, gross loss minus that is good. Okay, so we have a winning system. If the average win is less than the average loss, we can assume the trade is using a tight target and a loose stop. Be careful changing the targets. This will change the system. If average win is greater than average loss, do nothing. It's working well because our gross profit's greater. So don't do anything to that. But here's where we get into the problem. Okay. we'll switch the slide. If your probability of win is greater than your probability of loss, okay, and total dollar amounts lost and total winning amount is less, you're losing. You're in a losing system. Okay, so to correct this problem, we must A, notice it, and B, we need to plan to fix this. The first piece, I spelled that wrong, but I sure want you to have world peace and be calm. Okay, the first piece of data you need to know is which way the system runs first. Now, to do that, we express that in our what did we call it? We called it our B zone. Okay, I'm going to grab this and I'm going to pull it on, and I'll pull it on the screen so we can look at it again. And I'm not going to have it put the dots on. I'm going to have it do something where it samples the very most amount of data possible. Oh, I forgot to change the color of something. So I've got to do it. It wouldn't have printed anything. Here, I'll bring it up. I had to change the font color to white because we're on a black background. It wouldn't show up. And I'll have this on the screen so you can see what I did here in just a second. Okay. Now, when you pull this indicator on, there's about a 40-minute video about how it works and what it does. But this thing's running for just a second. All right. Now we're just looking where it says remove. What this is going to do up in the corner, it says out of 1,400 events sampled, there was a 99% chance that it's going to drop next, but that it will continue to rise along that line. Okay, a 99% drop. Now, if we are long and it normally moves up, so we're long and it normally moves up, and it starts to come against us now. So here's the path it took. So we're going to read this. We're going to have a behavior map. Now, these are our behavior maps. So right here, we're going to divide this into 4 quarters. I'm just going to take this, divide it right into 4 quarters right here. And we're saying, okay, I'm long now. It's starting to drop. I'm long. It starts to drop. Well, as soon as it gets down past this point, close half your trade. Close half of it. Because the probability is that it will run and you'll get to work these, okay? If we are long and it normally moves down first, well, we can't do that. If we decided that we were long and it normally moves down first, we're long and it moves down first, this means we have to use a really loose stop. It's a pullback. Pullbacks usually move down, and then the second thing that will happen is it will move up because it'll draw back and then move up. So there's basically 3 core patterns that deal with this. That you have 3 simple basic patterns. Selling in an uptrend, it's going to go against you. In a pullback, it's normally going to pull against you because the market in both cases works off of physics. Okay, so I'm going to pop this up and I'm just going to say, look, the thing ran up and right here it ran up. Well, it's going to continue to run up. It will continue to run up. Doop, 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 doop. After it does run up, we expect it to pull back. Well, once we get a pullback and it starts in the pullback, it will continue to run down. Okay. On a breakup, it will usually continue to go your direction. Now that's important because depending on which way it goes first, if you say, oh, I'm going to stop out quicker because it's not going my way, well, it'll make your system worse because it'll come down, 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 and then turn and run up to your targets. So you have to know which way it goes first to be able to do this. All right, this becomes really important in your systems. So let's go to the next one. Ratios and expectancy. If your probability of win is less than your probability of loss, but your total wins are greater than your total loss, well, that's great. You're winning. You're winning. So if the average win in dollars is greater than the average loss in dollars, we can assume the system is using a risk-reward ratio greater than 1. What this really means is that if this happens, if your average win is greater than your average loss, you can automatically assume the risk-reward ratio is going up. Now look, this is saying probability of win is less than that. So what happens in pullbacks, your probability of winning like this, it comes down, 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 down. Your probability of win decreases, but the amount it could move is huge. It's huge. Okay. Now, that becomes really important. We can assume that the system uses a risk-reward ratio greater than 1. Normally, these will have loose stops, and it will move away from you before the target is hit. Okay. Now, if your probability of win is greater than yours less than your probability of loss, and your total wins is less, you're in a losing system. To correct this problem, you need to notice it. We need to plan to fix it. The first piece of data, the same piece, find piece. English teachers, find some piece. You need to know which way the system runs first. Does it move towards profit or does it move away from profit? Okay, changes in a behavior map. If we are long and it normally moves up first, sell part of the system when it pulls back. So midway down the behavior map, what's that mean? Well, if I take this and I say, oh, hey, it's moved into this bottom quadrant, it usually goes up. Like it said, there's a 99% probability of rise along this path. That's the path it should take. Then it should quickly reverse. That's average. If it reverses down here and heads down this way, and we were long, well, we better cut our losers because it didn't go our way. Okay? So this is loss prevention. It's stopping it. The other way to do loss prevention is make sure you're trading the right time of day. If you're trading a system and you're expecting 30, 40, 50, 80 pip moves, that doesn't happen at night. There's some spreadsheets that I don't know if I have them really handy, but they show you, well, there is a way I can show you. I'm going to bring up another chart. I don't care what chart it is. See, here's a chart, CAD Japan. And what this is going to do, there's an indicator in here, and it's called FATTools Dynamic Stochastic. And if you come down and you look at this, it should be right in here, FATTools Dynamic Stochastic. And we bring this on the chart, and we look at this. I'm just going to drop it on there. We go look at certain times of the day the volatility jumps. And this is an indicator that's saying when does it jump? And you can look at this. Whenever this means it moved 2 trading ranges. So if it's -2, it moved 2 trading ranges. Well, I'll pop it up so you can see it because it's jumping around a little bit. And then I'm going to move this forward. This is what's causing it to jump. You uncheck those 2 buttons. But if we go back in time and we say there, it made a huge move right there. I'm going to take that off right in about here. What time of day did that happen? Did it move 3 trading ranges down? Well, that becomes important. You want to find that out. And basically, there's another way to discover the same thing. You count the number of bars above, the number of bars it went up in one direction. That's important. So you can catch that and try it. Now, with that thing tells you, hey, be sure you're trading the right time of day because there's only a few times a day that you can expect monster moves. You can't. You could position yourself for those monster moves because they always happen, but there are only certain times a day that those monster moves will occur, and that's what you need to be cognizant of. Okay, stops and target. Check the ratios and understand if the risk-reward system runs on a expectancy system. Expectancy means you're just going for a few ticks, high win rate, really loose stop. Make sure the stops and targets do not fall into Brownian motion. This is tough. Brownian motion really means this. You see, this is a trading range right here, right between here and here, a trading range. Those candles didn't go straight up. They overlapped each other. They overlap. One candle drew into the other candle, drew into the other candle. If you ever put your stop tighter than one candle in there, you're going to get stopped out all the time. All the time. There's reasons to do that, but you better have really good commissions and very good spreads. But you can't ever put your stop or target closer than that. You'll just get stopped out all the time. Okay, make sure the stops and targets don't fall inside there. And understand what type of system am I running with these, because it's a relationship of the ratios. Now, trends. When you run a trend and you want to find out strength of trends, there's lots of indicators that we can do this with. I'm going to go to File. I'm going to go to Tools, Options. I'm going to drop this down to like 5,000 bars. I'm going to go to File, go to Exit. This indicator requires less data, okay? I'm waiting for this thing to pop up. Okay, it's coming up here on the other screen. Do you hear that? It went bloom, bloom. That means that it started. I'm going to bring this up, and I'm going to go to File, Profiles, and I'm going to go down to USD. So these are all charts it brought up. Then I'm going to go to Insert, Indicators. I'm going to go to Custom Indicator, and I'm going to go down here to Correlation Breakout. See where it says breakout and down? I think that's all it says. Now remember, this is USD, Euro USD. A guy named Gerald had a good idea for this, for it to sense and ask you, do you want to look at the Euro or the USD of whatever chart you put it on? This asks you if you have all the charts open, is what it's trying to ask you. Yes, we do. And now all you're looking for is you're looking for really high breakouts. Okay? You're looking for a really, really high number. You're going to go down and try to check for a super high number. Like there showed the US dollar weakening, but it was only 4 data points. 4 things said the US dollar weakened. Boom, it went down and then it went up. Okay? So the US dollar is now strengthening, but these two right together started to tell you, whoa, there's 6 of them that broke the same direction, start going that way. Right on Friday at the close, it started to show you that it was reversing. This indicator just gauges strength of trend. It's telling you if this one, because this is Euro USD and we're looking at the USD, here the Euro strengthening, the USD is weakening. You see that? The Euro USD is strengthening, the USD is weakening. All right, so we look at that and we want to look and see what happened at certain times of the day. Stronger, the higher that number is, the stronger the trend's going to be in the last multiple hours. But there's a different thing to look at that. There's a little sheet that I published Sunday night that tells you the probability of trending at a certain time of this upcoming week because of what's going on. Okay, so we use that. But it'll be coming up. It'll be coming up Sunday night. I'd have to show you how that comes in. So we have trends that can tell us stuff. Now here's our vocabulary stuff. This is our maze, our adverse excursions. This is all your vocabulary. I'll post this. I'm going to save this under the help section of the tools. You'll be able to access this PowerPoint. Okay, you'll be able to change it and look at it. All right, now this is section 1. It's about an hour. The second section that we're going to put up is going to be loss recovery, and that one's going to probably be 2 hours. This one was just to highlight the concepts, not really get into the detail, but the concepts driving preventing loss. And ratios are an important part of that. When the ratio starts to get unbalanced, you can tell that your system's starting to unbalance. All right? The next one will be about loss recovery, and we have one about sizing that's already done. Okay, I'll talk to you guys on the flip side.